6 years ago, the chopping up and selling on of risk brought the financial world close to disaster. Then it was subprime mortgages, and when the value of those home loans fell, the whole system was exposed to the losses. Now there's a new, risky, little understood investment. They're called, appropriately, catastrophe bonds.
Catastrophe bonds are being bought increasingly by UK pension funds and by US pension funds, and I'm not sure whether they understand the real underlying risks.
Catastrophe bonds are basically a bet against natural disasters, like hurricanes or earthquakes. Insurers issue the bonds, and investors get paid interest every year. At the end of the term, they get their money back. But if there is a catastrophe, then the insurers get to keep all the money to cover their losses, and the investors lose everything. So far, the returns for investors have been pretty good, almost 8.5% a year since 2002. And they're also a hedge against market losses elsewhere. Catastrophe bonds are what's called an uncorrelated asset class. That means their return doesn't reflect what's happening in other financial markets. As long as the specified disaster doesn't happen, the investor keeps getting paid. Investing is a trade-off between risk and return. What's the chance that you'll lose money? And given that risk, does the rate of return justify taking it? For example, would investors buy something that had a 1 in 4 chance of making a loss? Not if it paid 5% a year, but they might if it paid 50%. When it comes to catastrophe bonds, Giovanni Garcia calculates the risks of disaster.
Typical bonds are designed to trigger at a probability of 2 to 2.75% every year. So that really means that on average, over a long term, the bonds are designed to trigger once every 35 to 50 years.
Since 2007, direct investment by pension funds in catastrophe bonds has gone up by 15 times. But while the risk of disaster is a constant, the rates of interest offered have fallen. As more investors pile in, bond issuers can offer lower rates of interest. Rates on bonds are now at record lows. Are pension funds exposing themselves to massive risk for too low a return?
This is a completely different sort of risk. It's a completely new risk for pension funds to be getting into. And I'm just not sure that they have the experience or the expertise in seismology, hurricanology, futurology, whatever it might be, to allow them to make a proper, informed decision.
The reason why pension funds are dabbling in catastrophe insurance is down to a much bigger shift in global finance. Central banks created a sea of money in an attempt to clean up the mess from the last crisis. But this has flooded into all asset classes, from bonds to shares to housing. That sea of money has been partly created by keeping interest rates near zero. Over the last 6 years, interest rates have been at historic lows, so pension funds haven't been able to get the kind of return they need from traditionally safe investments, like government bonds. Instead, they've been forced to buy riskier and riskier assets to try and drive up their returns. Since the crash, this search for yield has been the defining characteristic of financial markets. Some people see it everywhere.
I think there's, in one sense, a lack of discretion in terms of what investors might be investing in currently. Anything with a yield will do.
Stephen King is HSBC's chief economist. He sees low interest rates fueling a search for higher yields across all financial markets and driving ever greater risk-taking.
It does reflect the fact that investors are desperate to get higher returns, find it very difficult to find those higher returns when the economies are so incredibly weak, and as a consequence they're being sort of pushed into areas which are either riskier or more esoteric.
The risks are real. The valuation of many cat bonds today is based on a minimal possibility of disaster. A major disaster could trigger large losses in some bonds, which could bring down the price of all of them. The worry is, so much money has flooded into catastrophe bonds that they've become overvalued. You can see the same alarm signals across all sorts of different financial instruments. A loss of confidence in any of these could trigger a sell-off across wider markets. Low interest rates have been used by central banks to try to restore the economy to health. But they've been so low now, for so long, that investors are taking risks they otherwise wouldn't take. Catastrophe bonds might prove a risk too far. The next, little understood investment that could spiral into disaster.